This is Steve Hayes in London at the EPRA annual conference. I have with me now John Hammond, Head of Real Estate Securities at RREEF. John, welcome. John, how do you see the general outlook for the European real estate market overall in the next 12 months?
Well, I think it's going to be a challenge to be honest. I think probably in terms of growth levels, flat is probably an optimistic assumption at the moment. I think you could probably split it between some of the different geographical parts of Europe, perhaps across some of the sectors. Generally, there's still a reasonable level of growth in retail across most markets. I think that's probably going to be trending down. I think we're still to see the impacts of many of the austerity measures coming through across Europe. Hopefully we can keep around the sort of zero level, hopefully not into negative growth in retail. Whereas I think office is a little bit different. Office is coming back up the other way. Generally limited growth around in the office markets at the moment. There are some patches, London, Stockholm, perhaps parts of Paris. But I think we might see a slightly better improvement, getting more of the office markets up to that zero level. But flat, I think, is probably where I'd be as optimistic as getting to at the moment.
And within those markets, are there particular markets that you favour or you think are probably the worst option at the moment?
We're trying to look for markets, particularly where there's economic insensitivity, so limited price elasticity. And I think you can pick out markets, they're reasonably niche, I think, but markets like the healthcare market. Unfortunately, no matter what times are like, we all need to call on that from time to time. So healthcare is pretty good, particularly if you can find ideally a direct link, but perhaps indirectly government funding behind that, as opposed to exposure to particular operators. I think, again, things like education, so student accommodation. There's some issues in the UK in terms of some of the funding, but generally across Europe, again, education needs are still picking up. There's still a demand for people to take space for students to live in. So that's another good example. I think perhaps on the retail side, convenience type shopping. I mean, supermarkets look pretty interesting. You've got to buy the food every day. So some of those sorts of sectors, I think, will continue to do better generally than some of those sectors where there's more price sensitivity around the purchase of goods. And
how about the listed sector then? How do you see the outlook for the listed sector over the next 12 months? We've had a bit of a correction in the last couple of months. Where do we go from here?
Well, I think against some of that perhaps slightly depressing outlook on the direct side, there has been a bit of a setback in the listed market, and I think the listed market had seen some of this and has started to price some of that in. So I think probably if you were comparing returns direct against listed, I'm probably more optimistic that you might get to the slight positive numbers in the listed market, particularly if you take a 12-month medium-term view. The challenge for the listed market, I'm afraid, in the short term is the volatility. And I think you'll see the direct market appearing to be steady and okay, and then I think it might tail off slightly more rapidly. So some of those issues, I think, are much more in the pricing of listed markets than they are in the pricing of the direct market today.
And what about other equity sectors relative to real estate? What's your impression that investors feel at the moment?
Gosh, I'd say other areas of equity markets are not necessarily my expertise. Yep. But again, I get the sense that the issues are all around that predictability and sensitivity of the cash flows. So you'll find markets like some of the consumer durables are done reasonably okay. The pharmaceutical market's done okay. So where you can see those cash flows not being impacted by some of this economic uncertainty, or to a lesser degree, certainly. Those markets seem to have done okay. In a strange way, if you buy the right sort of listed real estate, as I've said, perhaps supermarkets, perhaps some of those other sectors, you should be getting some of those sorts of characteristics. Unfortunately, in Europe, we don't really have enough of those pure play opportunities that are big enough, frankly, in some of those sort of sectors.
And is RREEF positioning itself for the sovereign debt crisis? I mean, what's your view of some of those southern European listed markets or companies that have exposure to them?
Again, I think there's two answers to the question. Yeah. In terms of the operational side of what they're doing, many of the companies, particularly if you look at Italy, for example, the operational side is okay. The rents haven't collapsed, they're collecting the rent, there's very limited insolvencies so far. The problem is the risk element around what happens to the euro. I think, frankly, we've got to the point, in my view, of having kicked the ball along for so long that we're going to have to go one way or the other. I think that either means a euro breakup eventually, or it means that the Germans and the French agree with the Greeks to have some control over how those budgets are managed, and we eventually get Eurobonds and everyone comes together. The problem is that the outcome for the peripheral markets is completely different depending on which of those happen. And frankly, we all have a view on it, but would I be sitting here and putting our clients' money on the line to make a decision against one of those? I think that's a very difficult thing to do. Generally, we've tried to avoid those markets, just to avoid being at risk of one of those things coming out rather than the other.
John, thank you very much. For this and other industry interviews, please go to EPRA.com and REEF.com.